we've been in a perfect storm situation for the housing market where you had a few factors coming together at the exact same time. Nothing can go straight up forever, including home prices. And the concern is we have seen housing prices grow at insane rates. I mean, we're talking about 13+% a year in the last year, while wages haven't been keeping up. And at the end of the day, in order to sustain growing housing prices, you need people to be able to afford homes. I didn't grow up with any financial education. I didn't grow up with people telling me to invest my money or entrepreneurship. I didn't grow up with any of that. So when I started learning about investing and entrepreneurship, I was angry, man. Like, why are we never taught about money? Why are we never taught about investing? Why are we never taught about how to build wealth in school? I went through so much schooling, but was never taught any of this.
Guys, we've got a really exciting episode for you today. As you know, we love doing research. We love delivering content, education on your behalf. One of my personal favorites, though, is bringing people, like-minded folks on the channel, whether they're from the private sector, whether they're fellow YouTubers. And today we have the latter. We've got an amazing YouTuber on here that many of you are probably going to be familiar with already. I've been a big fan of his channel for many a year at this point. I could not be more excited about this collaboration. We've got Jaspreet Singh on the channel here today, and many of you may know him from the YouTube channel Minority Mindset. So with that said, welcome to the channel.
Oh man, thank you so much. I'm excited to be here, and it's an honor to be on with you.
Yeah, well, we don't take those compliments lightly, so I certainly appreciate you saying that. Been a big fan of yours for years. I like
Thank you.
So let's go ahead and dive in here today. So we've got a handful of topics. We kind of just want to keep this interactive dialogue here. This is certainly not, an interview, but, I want to pick your brain. People hear my thoughts on the channel all the time. They hear my partner Matthew's thoughts on the channel here all the time. We want to bring in, some fresh opinions here. We share a lot of the same, but we do have some differences. One of the things I really want to dive in today, which I know is one of your specialties, is going to be real estate. We're going to go ahead and first and foremost drop the link to your channel here below. You did a video recently on saying, is the housing boom over? We're going to go ahead and drop that link below, guys. This is a great video. We love to bring real estate here on the channel. What are you seeing? People are going to be able to go through that video. I've been on here falsely accusing the market of correcting for the last 3 years here at this point. All we can do is kind of read the tea leaves, look at market trends, follow the data, which I know you do as well. I'm a numbers guy, I'm a data guy, but what are you seeing out there in the market? Give us your take.
So, the facts are markets go up and markets go down. And this goes across assets, real estate, stocks, cryptocurrency. You have bull markets, you have bear markets. And during the 2008 crash, we saw one of the biggest bear markets for real estate ever, where real estate prices came down in some places 95% off of their highs. And after that, the real estate market bottomed out in 2012. From 2012 until 2018, 2019, it was growing very quickly. And then in 2019, we started to see a little bit of a slowdown in the economy and the real estate market. And that's when we saw interest rates actually get cut in 2019 before the pandemic. And then came 2020, the pandemic came. Interest rates were cut again significantly to historic lows. And then we saw a massive boom in the housing market, which drove a record number of people into the housing market. We've seen housing prices grow by over 13% in the last 12 months. And that's just like the average. So in some places you're seeing way higher, some places a little bit less, but across the board, you're seeing massive growth in the housing market. Now, like every other asset class, the price of an asset, in this case houses, depends on what somebody else is willing to pay for it. And, I might think my home is worth $500,000, but if no one's willing to pay me more than $450,000, it's really only worth $450,000 today.
Willing buyer, willing seller, right? And what they're willing to accept, what someone's willing to pay. Yep.
Exactly. And we've been in a situation, we've been in a perfect storm situation for the housing market where you had a few factors coming together at the exact same time. First, we had a very low supply of homes available for sale. Some people were scared to sell their homes because of the pandemic. We had the foreclosure moratorium, which didn't allow banks to foreclose, and people just weren't selling their homes. Second, we had extremely low interest rates, mortgage rates, like I talked about. The Federal Reserve Bank had cut mortgage rates to historic lows, so people wanted to take advantage of that. And third, we saw a massive demand because of the shift in the economy. When this pandemic hit, people were able to work from home. When you're working from home, you want a nicer home, or you want a home with an office built into it, and you're moving out of the city into the suburbs, into a home, and now you want, your yard and you want more stuff. And so you have a lot of people that now wanted to transition, get a new home. They wanted to take advantage of these low mortgage rates. And on top of that, there was no homes available for sale. So you created this perfect storm in the housing market where now people are fighting each other. Buyers are fighting each other to buy a home. The way you fight each other is through bidding wars, right? So the home's on sale for $500,000. I really want the home. I'll pay you $550,000. And this goes on and on and on. And we've been seeing this happen since, early part of 2021 and even the late part of 2020. We saw this real growth in housing prices, but nothing can go straight up forever, including home prices. And the concern is we have seen housing prices grow at insane rates. I mean, we're talking about 13+% a year in the last year, while wages haven't been keeping up. And at the end of the day, in order to sustain growing housing prices, you need people to be able to afford homes. Well, the issue right now is somebody's going to go look for a home. I can afford a $300,000 home, but the $300,000 homes are selling for $350,000. And so people are looking at these homes and they're turning away because they just can't afford homes. Now, you still have a section of buyers out there who can afford to pay the higher prices, fine. And, some people that are willing to stretch a little bit further, fine. But you're seeing more and more people turn away because they can't afford homes. Now, the interesting thing is people are subsidizing these higher home costs in their mind because of super low mortgage rates. Well, I mean, mortgage rates are bound to go up. Do they have to? No. I mean, you could see mortgage rates go negative, but the way that our economy is, the way that the Fed keeps talking about it, mortgage rates are probably going to go up. And when mortgage rates go up, it's going to be more expensive for people to go out and buy a home. So now, if wages are not keeping up with home prices and home prices are extremely high, and then mortgage rates go up, it's going to be harder for people to go out and buy a home because now your monthly payment to go out and buy that $300,000 home is going to be way more than it was a year ago when mortgage payments were less. So that's the concern. And if wages don't keep up, well, then people are going to say, I can't afford a home. I can't afford the $300,000 home and I don't want to live in this small home, so I'm just going to rent. And if you see more and more people shift to not buying a home, well, now supply and demand shifts. Demand starts to go down, while supply would go up because more and more people are building homes and people are starting to sell homes now more because of the mortgage moratorium ending. So if you see that supply and demand shift, then that could cause either a housing price slowdown because there's a difference between housing price appreciation cooling and housing price appreciation going down, essentially housing prices going down. Because right now what we've been seeing is housing prices slow down. They're not growing as fast as they were, but they're still growing very fast. Mm-hmm. The question is, are we going to see home prices go down? And the tell for that is going to be, well, what happens when interest rates go up? If interest rates go up and wages don't keep up, people will not be able to afford homes. And then what you could see happen is sellers then list their homes for sale. I list my home for $300,000. I don't get any bids. I want to sell my home, so now I'll cut the price to $280,000 to make my home more attractive. And then if you see that happen, that could create a shift in the housing market. Now, the question everybody has is, are we going to see a real estate crash? Well, in order to answer that question, you got to first define what is a crash. And in the most kind of technical sense, a crash is when you see more than a 20% price drop. Under 20% is considered a correction. More than 20% is considered a crash. So what would it take for real estate prices to crash? Well, obviously, a correction wouldn't be a big surprise. I think everybody is anticipating some sort of correction in the housing market at some point, whether it's 2022 or 2023 or 2024. I mean, it's impossible to predict when. We can't predict what government regulations are going to come out, how they can change things, and what can happen with interest rates. I mean, there's so many different factors that can affect it, which are out of our control, which is out of the market's control, unfortunately.
Historically, they correct about every 10 years, so we're several years overdue at this point. Do you think it's the pandemic really propped up the housing market, kept it obviously at historically high pricing? Without the pandemic, do you think the correction would have happened already? I guess would be my simple question.
Well, it's hard to say because 2019 we were kind of going in that direction. We were already slowing as an economy, but then we saw the interest rates get cut in 2019. I think the Fed cut them 3 times in 2019. So we were trying to prop up the economy, which was supposedly the fastest growing economies of all time, even though we were still kind of slowing. So we were starting to see the effects of a slowing economy, but then we started pushing it. So it's hard to answer that because there are what I call it the X factor. Things that are out of control, government regulations, things that the Fed does, which sometimes we can't predict, or a lot of times we cannot predict. And those can have a real effect on the economy. And it's weird because in a free market, they shouldn't. But this is the world that we live in. But are we inflating it more? Absolutely. I mean, it's if we keep making home prices blow up with cheap debt, and then you want to start raising debt, well, then how are people going to be able to afford these higher prices? Because the affordability for a home comes down to 2 things. It comes down to the house price and mortgage rates. And right now, homes are, in some people's eyes, cheaper than they were a couple of years ago because you can get the same home on a lower monthly payment because interest rates are so much less. And so, it's hard to kind of see what is going to be the turning factor. We have home prices way up here, mortgage rates way down here. If mortgage rates start to go up and home prices stay up here, you're going to see a real affordability crisis, even bigger than we have right now in the housing market.
Yeah, so I think, just to kind of tie all that down, it's interesting because people that are kind of outside looking in at the housing market are kind of what makes it kind of ebb and flow the way that it does. Don't have this kind of granular approach to it. It's a tangled web. I mean, there are just so many factors that go into it. And right now we're at really unprecedented times. I don't think many of us out here that are walking the earth right now have been through the bubonic plague, or, major pandemics like that, of course. So, obviously it got everyone on their heels and they were reeling. And now it's like, how do we come back from it? I want to touch later on in the episode your thoughts on whether or not the pandemic, is it going to permanently affect our economy? But I want to stay on the real estate for now. But it's important for people to know that not only, housing prices, mortgage rates, government interaction, government subsidies, the stimulus took has affected the housing market. Obviously, the supply and demand, the supply chains, all of those variables really have gone into this melting pot, if you will, and that has left us where we are today. So even people that are out there doing all the research, obviously yourself as much or more than anyone, no one knows exactly what's going to happen because we haven't seen it before. And I want to touch on 2007 also here later on in the episode, but right now, mortgage applications are down, right? Month over month, inventory is increasing. Is that an indication? Now, you and I are both from the same school. I'm not anticipating an absolute crash. It's not going to go here and then just go straight down. It's going to be a little bit more of a controlled kind of slow growth trajectory as opposed to straight up. So you and I are aligned with that. But even, that kind of tapered off growth can turn south very quickly. Obviously, what are your thoughts on that? Is that kind of ebbing towards, a potential, not necessarily catastrophic crash, but obviously that slower growth?
So yeah, to 2 points to that. We don't have the same factors that we did prior to the 2008 crash. We don't have the same subprime lending and the same ninja loans and all the other same factors as before 2008, which is good news for the economy. The second thing regarding mortgage slowdowns, I mean, people are turning away from the housing market because they see housing prices. And the second thing is we are actually seeing the opposite of 2008 in the sense of people are not able to get mortgages because homes are not appraising. Wall Street Journal just did a recent write-up on this, where if I list a home for $300,000 and somebody makes an offer to buy it for $330,000, I'm going to accept the highest offer. Let's just say that's $330,000. Well, now the bank comes out and they appraise it. The appraiser might come back at $305,000. So now the buyer who wanted to buy the home for $330,000, who might be able to afford a $330,000 home, can't get appraised for $330,000. And unless they can come up with the extra cash, which a lot of people can't, now they're not going to be able to close on that home because the bank says we're not going to be able to fund you. And this is what we're seeing happen a lot right now, because people are just, they're overbidding from homes according to the banks. And because of that, banks are not willing to lend to some people. Then you have people that have gone through a lot of bidding wars and they're like, oh man, I'm tired of this. Let's just wait it out. And then you have people that are just, they look at the home prices and they're saying, screw that. I'm not going to pay this much money for a home, or I can't. And so, you know, there's a lot of factors into that mortgage application. And it also kind of varies on mortgage rates. It's weird because I'm friends with a lot of bankers. I want to get their insight on what's going on because I feel like that's the best way to understand. And, you know, what you see is mortgage rates go up. You'll see, you know, a month ago, mortgage rates started to go up pretty quickly and mortgage applications fell fast. And then right now, or a few days ago, when I was checking, mortgage rates came right back down to below 3%. And why are they doing that? Because every time they try to raise mortgage rates, people stop applying for mortgages. I mean, it's our housing market is so reliant on these cheap mortgages that even if they try to raise interest rates a little bit, people turn away. And that's, I mean, that just shows you what's going to happen when the Fed says, okay, we're going to raise interest rates, and then mortgage rates have to go up. What's going to happen? I mean, and if home prices keep going up between now and then, I mean, it's going to be interesting. It's impossible to predict, but I mean, people are buying homes because of cheap mortgage rates, and that's the only way they're able to afford these higher house prices. And unless we see a magical rise in wages between now and then, it's hard for me to think how people are going to be able to afford that, along with the higher cost of living. I mean, prices of everything are high, man. Try to buy a car right now. It's not easy. Everything is backed up and you're having to pay premiums on everything. And so it's getting harder and harder for people to afford things.
Mm-hmm. Yeah, no, great answer to that. You know, I talked to a lot of folks as well, and folks that aren't necessarily, I wouldn't call them not in the know, you know, but a common phrase I hear is, oh, it's going to be 2008 all over again, right? And
no.
Just in kind of a summary, define the difference in the marketplace from, you know, 07, 08, you know, you know, fallout, pre-crash, and then during the crash compared to, you know, current day. Just for, I wouldn't call them the layman, but just kind of in a nutshell, what are the differences there? Because there's very distinct differences between now and
Sure. Well, let me start by saying this. You know, home prices the housing market futures is very uncertain. But for people who are looking to buy a home, that's okay. Just make sure you can buy what you afford. You know, I'm a real estate investor. I'm still buying properties. I'm just being way pickier now than it was before because it's way harder to find a good deal. And so it's just be smart with what you buy, and spend some extra time doing research, and don't overpay. Don't get emotional. I mean, that's the reality, because we don't know how long whatever's going on will last. It's impossible to predict that. Prior to the 2008 crash, I mean, we had a few things happening. We had first a boom in variable interest rate mortgages, which meant if you go out to buy a home, it might be a 5% interest rate mortgage, but you get to come in on a 1.99% teaser interest rate for the first 3 years or 5 years. And then after that teaser rate, then mortgage rates go up. And there was a lot of behind the scenes things going on where bankers would really just advertise a teaser rate, and people were not financially educated, or they were lied to, whatever it was, where they didn't know how much mortgage payments would go up by. And bankers always told you that, you know, yeah, mortgage rates will go up. And if they do, if it becomes too expensive, don't worry, you can just refi out in 3 to 5 years or 7 years, and then you can just lock in a cheaper interest rate mortgage. So everyone saw the upside, but no one saw the downside. Then you saw the growth of subprime mortgages. So people who could not qualify because of the credit score to buy a home, you could now go out and buy a home because in the bank's eyes and in the government's eyes and in the world's eyes, home prices only go up. And the government was really pushing home ownership for everybody as the solution and as the cure to poverty and building wealth. Home ownership needs to be a right for everybody. And this is kind of, it's maybe a little bit extreme, but that's kind of the direction that they were going, that everybody needs to own a home, or it should at least be accessible to everybody. Then you saw the growth of ninja loans, no income, no job, no asset loans. And what that means is I don't got a job. I don't have any assets to my name, but I want to buy this $300,000 home. And the bank would say, okay, sign this paperwork. And you were even seeing home loans with 0% down payments. So you don't got to put anything down. You don't got to show any income. You don't got to show any assets. The bank is going to give you all the money you need to buy a home. And if they're not, you can get a second loan to do that. That way you don't have to put any money down. And the bank's also going to give you a TV if you close by this Friday.
Right.
This was the insane things that we were seeing.
I think I saw that commercial. Yeah, I think I saw that exact commercial.
Right. And so it's, I mean, it sounds funny, but this is the reality of what was going on. So we had risky lending going on, and this was on the consumer side, on what banks did with consumers. Then what happened was mortgage rates went up, and all these people who were on these variable interest rate mortgages now saw their payments double, sometimes even triple. So you went from paying $1,500 a month, or let's go even easier. You were paying $500 a month, and now your payment went up to $1,800 a month. How are you going to afford that new payment when you were going paycheck to paycheck at $500 a month? And so now you said, okay, well, the banker said, let me refinance out of my mortgage and get a lower, cheaper interest rate mortgage and lock it in. Well, home prices started to go down, and now you couldn't refinance. You had no equity in your home, and now you couldn't sell because you had to bring $20,000 to the closing table if you wanted to sell. So now you either walk away or you find a way to pay that extra $1,300 a month. So that was a trigger of the housing market crash. But the real kind of explosion then happened in the derivatives market, because then what happened was banks, which is still happening right now, this derivative stuff is still kind of going on, where banks were, they would take your loans, chop them up, sell them as certain investments. They would market them as these perfect investments, sell them for these high prices, and then they would get insurance against their investments. So it just became this whole kind of behind the scenes, people selling the same investment again and again and again and again and again, leveraging their investments up. So then when the housing prices started to go down, it wasn't just the housing market, it became the whole financial sector, because you had all of Wall Street betting on the housing market, and not just betting on the housing market, but betting on the same deal 10 times or 100 times. And that was just propped up with infinite amounts of leverage. So when home prices started to go down a little bit, it affected the economy 100 times over. And so, that derivative market has not gone away. I mean, derivatives are bigger now than before. I think prior to the 2008 crash, there was something like $700 trillion worth of derivatives in the economy. In 2018, it was something around $1.2 quadrillion of derivatives. So that obviously is concerning, sure. But on the consumer side, things are not the same. Now, that is something you want to pay attention to, because like I said, I like to talk to bankers just to see what's going on. Now, there's no real answer. I just had to say, how's the housing market doing? Are people still buying homes like crazy? Just trying to see what, how they're doing. And they're very open, because bankers love talking about the commissions that they get on selling homes. So, they start talking about it. And what was interesting is, we're recording this in October. I think it was September that somebody told me that their variable interest rates are becoming popular again. And I said, what are you talking about?
I don't remember the last time I've seen one.
Yeah. And he said, people were having because when mortgage rates started to go above 3, people were having a tougher time buying a home. And then he said, yeah, I mean, people can get a variable for the first 5 years at 1.99. And I said, you got to be kidding me. Now, obviously, is it as popular as it was before the 2008? No. But that's concerning to me that variables have come back in a sense that some people are starting to get them. And so as mortgage rates start to go up, that's something that I'm going to pay attention to is, are we seeing more variable interest rate mortgages? And if so, how long are their rates? Because, how long are these teaser rates? Because that's something that, you need to pay attention to.
Mhm. Yeah. So obviously very distinct differences between what's going on right now. Obviously, we're not anticipating a crash like that. We don't have the subprime. Banks have learned the hard way. They've been governed much harder since then. Obviously, they don't have the same leeway. They've got reserves now that are required that they did not have those checks and balances back then. So don't see that happening again. But I'd love to kind of lay out those distinctions. So we've talked a lot about interest so far, interest rates on this so far. Inflation is obviously a hot button topic. Did a video recently. I'm going to go ahead and drop the link to that below, guys. Inflation's kind of just, you hear about it every day right now. I mean, cost of goods and services are through the roof right now. I've got some stats right here. So this is since the pandemic, the outset of the pandemic, food is up 5.4%. Energy up 8.9%. You talked about cars, new cars up 5.3%. Used cars up 43.4%.
Oh my God.
That's insane. And then we talked, everyone heard about the lumber shortage, obviously, and the supply chain issues with that. So just from the pandemic, $399, and this is dollars per thousand board feet, spiked at 1,500 in April of 21, settled back down as of September 21 to 627. That's still a 57.14% hike since the pandemic. So obviously the pandemic's coming into play. Gas since January of 21, up 35.12% across all grades. When is there an end in sight? Jay Powell keeps coming out and talking about, we're not going to raise interest rates. We're not going to raise interest rates until 23, 24. It's the general consumer that's paying the price though right now. So does the bleeding stop? When is it going to stop? How is it going to stop? What can the Fed do to control this, if anything, and should they?
So, yeah, and it's interesting that you bring this up because, we talk about the housing market and for the last part of this discussion, we looked at the housing market individually, like as if it was in a bubble. But the factors in the housing market are in a bubble if we look at just that. But the whole economy itself does affect the housing market. And the factors in the economy that you're talking about do affect the housing market. And those are much more concerning to me today than the individual factors in the housing market, because these economic factors that you're talking about, oh man, I mean, these things have real repercussions, and it is going to be very hard for our economy to get out of this mess. And our whole economy is in a real state of limbo. So, you talked about all this inflation. Why are we seeing inflation? So obviously the Fed keeps saying that it's supply chain issues. That's why it's transitory. But we ignore the fact that we had printed trillions and trillions and trillions of dollars in 2020 and 2021. I mean, in 2020, we had the worst recession since the Great Depression, and it lasted 2 months. Why? Because the Fed stimulated our way out of it. Now, what are we doing here? We are stimulating away from risk. The Fed wants to avoid that risk of losing money by stimulating more money. That way, all you see is upside. In the short term, that's great. You save the stock market. The stock market continues to rally, but at what cost? Free money is the most expensive kind of money there is. So, when the stimulus checks go out, when the unemployment checks go out, when the corporations get their bailouts, when the stock market gets the $120 billion check every single month, which is still going out, all these things, hey, they look good. I got some money. Either the stock market's going up, it's good. But then you see the price of groceries going up, and then you see the price of housing going up because there's so much more money, dollars in circulation, which is causing the price of everything to go up. Inflation is when the value of our dollars go down, which in result causes the price of everything to go up. This is a much bigger concern to me because how do you fix that? And obviously, there are ways to fix it, but they are painful. And is our economy and our government and the Fed going to do that? I don't know. I mean, right now, the Fed is still printing $120 billion a month and injecting this into the markets to keep investors and institutions confident in the stock market. Why don't they stop that? Well, in 2008, we saw the same thing happen. The Fed did a lot of quantitative easing. They were pumping up the bond market, and they were making it more attractive for investors to put their money in the stock market. And when they stopped, all of a sudden, you saw a little bit of a crash in the stock market because people were worried about the Fed pulling away. It was called the taper tantrum. And so now in 2021, the Fed doesn't want to stop because they are worried about a taper tantrum. And so what are they doing? They keep printing money and pumping it into the markets to keep institutions and investors confident. And they keep talking about how they want to stop this money printing, but they can't because they're worried about a taper tantrum. And so, who are we valuing here? Who is the Fed valuing here? Well, they got the backs of institutions, banks, and the market, but it comes at a price because now regular people are having to pay way more money to buy a home. People are having to pay more money to get health insurance. People are having to pay more money to buy groceries. They're having to pay more money to go on a vacation. And this is, how do we stop it? The Fed keeps saying that it's transitory. The government keeps saying it's temporary. And then I just released a video today. It was so Michael Burry really kind of popularized this. He called the Fed out. He called them, essentially said they were lying for their inflation numbers. And the video that I did really dove into that as an analysis, because what the Fed does when they talk about their inflation numbers, because they say that they want 2% inflation and they want certain inflation. And I'm going to talk about why in just a second, which is probably the craziest thing. But the Fed knows, or they say that, we don't want to see too much inflation because it's bad for the consumer. But when they look at the inflation numbers that they have, they take a derivative of inflation numbers. They skew the data, and they publicly state this. That way, inflation doesn't look as bad as it actually is. So you have two different inflation numbers. You have CPI, then you have PCE. CPI is what the news talks about when you hear about inflation. Then you have PCE, which is what the Fed uses, which is kind of like CPI. CPI looks at 8 different industries like clothing and housing costs and all that, and they average it all together to come up with the inflation numbers. PCE looks at that, but they take away food costs and energy costs. So now the Fed takes this inflation data and they put it on a chart. And they see, okay, we have some high inflation here and some low inflation here and some in the middle inflation here, because some things like used cars grew way faster than other things. Some things we didn't see much inflation, but across the board, we have a lot of inflation. Then what the Fed does is they delete the top 34% of inflation. So anything that has saw the most inflation, the top 34% of it, they just erase it. And then they look at the bottom, I think it was 24% or 21%, and then just delete that. So now you have this wild inflation graph. You take off the top third, you take off the bottom fifth, and now what do you have? You have an inflation line that doesn't look too bad. And that's how the Fed comes up with their inflation numbers. And then they say, inflation isn't that bad. So we can continue money printing. We can keep the low interest rates for a little bit longer. Now, I got trust issues, all right? I'm a very trusting person in business, and I think I'm a little bit too much, which has burned me in the past. But, I got trust issues with the government and the Fed, man, because, growing up, I had real, I didn't grow up with any financial education. I didn't grow up with people telling me to invest my money or entrepreneurship. I didn't grow up with any of that. So when I started learning about investing and entrepreneurship, I was angry, man. Like, why are we never taught about money? Why are we never taught about investing? Why are we never taught about how to build wealth in school? I went through so much schooling, but was never taught any of this. So I started to really kind of lose my trust for the school system. Like, dude, I spent so much money in my higher education thinking that this is going to help me become wealthy, but never once did I learn a thing about passive income or wealth or financial freedom. Not once. So, the government and the Fed keep saying that, we want inflation under control. We want to take care of people and this and that. But the reality is the government wants more inflation. They need it. because right now the United States government has something around $29 trillion worth of national debt. 29 trillion. And so if we see more inflation, that means that the government can now pay back this national debt with cheaper dollars. It is the only way that the government has any chance to even make their payments on this debt. They need it because they have spent so much money, they have borrowed so much money that if they have, the only way they can pay this back is through more inflation. Because if we were to see the opposite, deflation, that means you got to pay back this $29 trillion with more expensive dollars. The government can't afford that. I mean, we're already raising taxes. We have taxes are when you and I work, and everybody who's watching this work, whether it's through their business or whatever, we earn money and we pay the government a piece of these taxes. The government then takes these taxes and they want to invest it into infrastructure and taking care of the economy. But just like anything else, when you have debt, you have to spend money to pay at least your minimum payment on your debt. The bigger your debt is, the bigger your minimum payment is. Well, between 2020 and 2021, the US national debt ballooned. I mean, it just exploded, which means the minimum payment, right, for the government also exploded. So more of our tax dollars are now going not for infrastructure and to help the people per se, it's going to pay back this debt plus interest. And so, that's one of the reasons why, the government keeps talking about the need for raising taxes. It's not just for more infrastructure. It's so they can pay back this debt.
Right. And I've heard recently that some of these plans, they cost $0. And I mean, you can't help but laugh at that. I mean, people are seeing it right now. Obviously, inflation goes up. Obviously, cost of goods goes up. Just the cost of them sustain their normal livelihood obviously is going up. So someone is paying the piper there. Wages go up. Obviously, the same thing can happen because obviously the employer is going to have to compensate for having to raise those wages. So someone is going to pay. The general consumer, their customer, obviously is going to get price hikes there. So nothing comes for free here, folks. Someone is ultimately going to be paying the piper on it. And in most cases, it is us.
It's people. And I mean, it's really bad for people on fixed incomes. I mean, Social Security, and especially if you're relying or planning to rely on Social Security when you retire. Because, we've been talking about Social Security drying up for years now. Well, now it's an even bigger issue because right now, if you go to work or if you own a business, you're paying Social Security taxes because when you get paid, the employee and the employer pay Social Security taxes together. Half is paid by the employee, half is paid by the employer. Now, if you didn't pay Social Security taxes, you could get a 12, 14% raise on your income because that money is no longer going to taxes. But the whole idea was this money is invested for you by the government, so you have money when you retire. Only problem was the government didn't expect people to live past the age of 74. So now people are living longer. Good news. Bad news is the government doesn't have money to keep paying you. So the money you're paying in Social Security taxes today is not going to fund your retirement. It is going to fund somebody else to retire. And so this is why the issue of Social Security drying up is becoming a bigger and bigger issue. And this is where everybody says, oh, well, it's not that big of a deal because the government can just print more money and fund Social Security checks. And you're right, they can. And if it comes to that, they probably will. They will print more money, send out bigger Social Security checks. But what does that really mean? The government sending out bigger Social Security checks, which might look good, like, hey, you got a bigger check in the mail, but then you're ultimately diluting the value of your security checks at the exact same time because when they print more money, the value of your dollar goes down. So yeah, you got a bigger Social Security check, but it has less buying power and it can't actually stretch as far. So now you're poorer than you were before with the smaller Social Security check because the government just kept printing money. Then they also have to fund all the other administrative stuff. This is a real concern. And it's obviously this goes beyond just Social Security checks. This goes across the economy as we printed trillions and trillions of dollars in 2020, 2021. Now, where did that money go? Obviously, some of it went in the form of bailouts to corporations. Some of it went to the stock market bailouts. And then you had, money going to people in the form of unemployment checks and stimulus checks, which were great in the short term. You got an extra $1,400 or $5,000. But then what did people do with that money? Well, People needed groceries, so they went to Amazon and Kroger and Walmart, and people went to Lululemon, and they went to Gucci, and they went to Apple, and they shopped more.
Yeah.
So all this money was printed and entered the economy, either to the stock market or corporations or people. And then what happens? More money is printed, the value of each dollar is diluted. People get this money, and then it flows back up to the rich, because now you go and spend this money. So now the average person either has less dollars or the same amount of dollars as before, but each dollar that you have is no longer worth as much. So we're creating a bigger divide between the rich and the poor, because now people who are not financially educated get hurt. Inflation benefits the people who are financially educated and hurts the people who are financially not educated.
Yeah, and that resonates with me. It certainly resonates with the people on our channel. Obviously, we preach financial education. You do that on yours as well. Guys, if you want us to bring more content like our channel friend here, Jaspreet Singh from Minority Mindset, what do they need to do, Jaspreet?
Well, you can check us out on YouTube, Minority Mindset. We just launched a news channel, Minority Mindset News, where we publish daily updates on the top finance and business news. You can go to our website, theminoritymindset.com, or all socials at Minority Mindset.
Mm-hmm. And then what do they do with their thumb?
Oh, anytime you go, make sure you smash that thumbs up button below.
I love that. That's never going to get old. That's never going to go old. Guys, but obviously on this channel, we always try and shed light on financial education. Obviously, Jaspreet's an expert on that as well. That's what he preaches. Guys, you don't know what you don't know. You need to surround yourself by like-minded folks. You need to go out there and do your own research. Obviously, we're going to do a ton of this research on your behalf, but you have to know, particularly, like you said, there are people with fixed income that are either in retirement or headed towards retirement. Inflation needs to be on their radar literally every single day, and how to, kind of maneuver their life at this point to kind of insulate themselves, I guess, to an extent. So let's move on from that real fast. Let's talk about what are you doing investment wise right now? I know that you said that you're out there still buying some real estate, a little bit more hesitant or a little bit pickier than maybe you were. What are you bullish on though right now?
So, investing is a double-edged sword, because on one hand, you could be buying at the peak, and the second end, if we see a crash, then cash can be very handy, because then you can buy things at a discounted price. Now, it is impossible to time the market. It's impossible to know when a crash is going to happen. So when I invest, I just make sure the deals that I do are things that I want to believe in for the long term. So I invest in 5 places: real estate, stocks, businesses, crypto, and commodities. Real estate, I invest for cash flow. And, housing prices are higher, real estate prices are higher. It's harder to find, all types of real estate. But I'm just making sure that the deals that I do find are good and they have room for error. So if we do see an economic slowdown, I can still, we can lower rents and still be okay. So, I'm not overpaying. I'm not getting emotional, but I love real estate because I love being involved in my investments. I love the entrepreneurial side. I love renovating properties. I love kind of revitalizing areas. So I like real estate for that purpose. And it comes with cash flow. Second is stocks, because I believe in the American economy. We have a lot of issues, but I still believe that the American economy is the strongest economy in the world. And so I'm a big believer in that. There's 2 ways that I invest in stocks. I have a passive strategy where every week I invest my money into the market, and this is completely passive into ETFs. It gives me exposure to the general market. This happens whether the market's up or down. It just happens. And then I invest in individual companies. So I look for companies that I believe are undervalued, that I want to invest in for the long term. This is where I'm doing research on companies, and I'm studying them and trying to find something that I believe in and staying up to date on them. Then I invest in businesses. So obviously we have Minority Mindset, which is a company, but I also love investing in startups because I am an entrepreneur. I love working with entrepreneurs. I think entrepreneurs are necessary to save America. And I love the entrepreneurial mindset of wanting to change the world and wanting to improve the world. And I love getting behind that and helping people, and whether it's through my cash, my capital, or through my advisory services, whatever it is, I want to help entrepreneurs. I just love being around entrepreneurs. So I invest in startups, and, high risk because most startups will fail, but there's also high potential for reward. So this is something that I do. It is more accessible now than ever, thanks to something called Regulation CF, Reg CF, which allows people to invest in startups through crowdfunding campaigns. This is not like Kickstarter where you're trying to pre-order a product. This is like You have companies like WeFunder, Start Engine, and Republic, which allow you to you can invest in startup companies. And that's one place where you can go directly to startups. We have a lot of startups that reach out to us directly. So I love working with entrepreneurs, and I love innovation, and I love the whole side of things. Then cryptocurrency. This is the people's movement of money. That's what cryptocurrency is, where people are losing trust in the Fed. They're losing trust in the government. They're losing trust in the dollar. So they're trying to move away from that, from the bottom up. And they're switching to cryptocurrencies. And the interesting thing about crypto is it's not just a currency. It's the whole technology. I mean, it's a whole, obviously, one of the uses could be using crypto as a means of payment and exchange, but there is so much more to crypto. I mean, DeFi, which is decentralized finance, is a whole new industry of money, which is just happening and starting right in front of us. So there's opportunities for you to, if you want, you can invest in cryptocurrency, own cryptocurrency, you can earn interest on your cryptocurrency. And there are ways to, high risk options and low risk options. And there's things like stable coins, which don't really fluctuate, that you can earn interest on, kind of like, every DeFi account doesn't like when I say this. You're not supposed to say this, but it's kind of like a bank where you're supposed to earn interest on your savings because they lend your money out. But that's kind of what they're doing here, is they lend out your crypto and you can earn interest on it. So there's a whole industry that's just growing and starting. Now, could we see a crash in crypto? Absolutely. I mean, we could see a 2001 style .com crash in cryptocurrency. It's possible, but that doesn't mean that there's no use for it. There's a lot of value in cryptocurrency. And yeah, some things could fail, but there's a lot of things that will be useful 10 years from now or 20 years from now. And then I have commodities. I invest in physical gold. I believe in the economy. I think we have the strongest economy in the world, but I own gold in case I'm wrong. It's my insurance. It's my hedge. I don't look at it as an investment. I did an interview yesterday. Somebody was talking about gold prices. If I'm worried about it, I don't care what happens to it. It's just physical money that I own, because I know gold is a representation of value, because it takes time, effort, and labor to mine gold, as opposed to a dollar, which just takes a second to print, and it costs 12 cents to print a $100 bill. Gold is a real representation of value. So I own it for that purpose. And it's just a hedge. It's just something that I own, and nothing happens to it. Fine. It's just there.
I appreciate you sharing that. We might try and dive back in on a couple of those investment classes, maybe on a later video, if you're willing to come back here on the channel. It's
absolutely
really get updates from you. Kind of a parting shot here, if you will. If I'm watching, this episode here right now, and I'm kind of, a middle class individual, maybe own my home, maybe don't own my home, really want to level up my finances, what kind of recommendations could you make?
Well, there's 3 steps. And the first thing you have to do is you need to know how to save, as in live below your means, not just necessarily save all your cash in the bank, but more in the sense of know how to live below your means. If you don't know how to live below your means, you're never going to become financially successful. You have to know how to do that. And there's a whole spectrum of living below your means. Like, you can make $100,000 a year and live off of 95. That's technically living below your means. And you can also live off of 20, right? And so there's a whole spectrum of living below your means, and you got to figure out where on the spectrum you are, but you have to stop spending all your money. Second is the growth. So the faster you want to grow, the more sacrifices you're going to have to make. I mean, if you can put aside more cash, whether it's to invest in businesses or invest in your business or invest in real estate or invest in stocks or invest in cryptocurrency, it doesn't matter. I mean, there's so many opportunities in any one if you're willing to learn. And you need to know how to grow that money, which is step 2. But the more money you have, the more money you'll be able to grow. And obviously you can earn more money. You can, try to get a raise, you can get a promotion, you can start your own side business, you can start your own business. There's so many ways that you can earn more money. Again, it takes more work. It's hard. But as you have more cash, you need to know how to grow that cash without just you physically working. So that might mean investing in the things that I talked about, or starting your own business. You need to know how to grow the money that you do have. Once you really start to build that wealth, then it comes to phase 3, which is the spend phase. Because what happens to a lot of people, or some people at least, is you start to really accumulate wealth, but you never get out of the penny pinching mindset. You will never get rich by pinching pennies alone. And a penny saved is just a penny, right? And so there's a reason why you're working to become wealthy. And you need to understand that. And as you start to build wealth, start to enjoy your wealth and know how to spend it, because one of the most important ways to spend your money is just in a way that's going to buy back your time. And, we talk about real estate a lot. The easiest way to understand that is to think of a real estate investor who refuses to hire a property management company because they're going to take 8 to 10% or 6 to 10% of your revenue. And yeah, you say, why would I want to pay them $150 a month when I can just do it myself? Sure, you can keep $150 in your pocket, but now you're the one that's taking all the calls from your tenant. You're the one that's screening the tenant. You're the one that's doing all the work. I don't want to be in the management business. I want to be in the investment business and the ownership side of the business. And so, spending smartly means now buying back your time and using your money as a tool to buy you the things that you worked for. And so, that's kind of the spectrum of the way that you get there. But it all starts with one, stop spending your money on dumb crap.
Mm-hmm. Yeah, no, I appreciate that. It was a pretty insightful response there. Guys, it really does boil down to mindset. There's just very small differences between someone that's got a lot of money and someone that's got a little money. And most of that happens right up here. Not everyone's, born on third base. And in fact, most wealthy entrepreneurs started from scratch, really started with nothing. They just simply had that drive. They flipped that switch in their head. They put their head down. They surrounded themselves with the right people. They read the right books. They got the right knowledge. They became informed. And, that's what ultimately led them down that path to success. So that being said, Jaspreet, we loved having you here on the channel. Guys, we're going to go ahead and drop a link to his channel below. If you like the information like he was gracious enough to give us here today, you're going to love his channel. Tremendous content on there. You put videos out all the time. I'm addicted. So if you guys have not seen his channel, certainly going to encourage you guys to check that out. If you want more information like this, if you want us to bring special guests like Jaspreet back here on the channel, go ahead and smash that thumbs up below, guys. If you're a subscriber already, thanks for joining us again today. If you are not, or someone that could get value out of this information, go ahead and recommend that they subscribe as well. And ding that bell notification below. That's going to give you notifications and updates as we're bringing additional content like this on the VIP Financial Education YouTube channel, where we talk about all things credit, capital, and cash flow. Thanks for joining us. Until next time, guys, take care and make it a great day.
Thank you, man. It was a great time.
Got no money on my mind.